We want you to know.
China's debt problem has become one of the most pressing economic challenges of the 21st century, a structural issue that continues to evolve and deepen as the country grapples with slowing growth, demographic decline, and the long-term consequences of policies that prioritized rapid expansion over financial stability. At the heart of the problem lies the extraordinary accumulation of debt across multiple sectors of the Chinese economy: central and local governments, state-owned enterprises, private corporations, and households, all of which have borrowed heavily over the past 2 decades to sustain high levels of investment-driven growth, build infrastructure, fuel real estate development, and maintain political and social stability, with the result being an economy that is now heavily leveraged and vulnerable to shocks, particularly in its most debt-dependent sectors, such as real estate and local government financing vehicles. This reliance on debt financing was not accidental, but rather a deliberate strategy pursued by Chinese policymakers to maintain employment, urbanize the population, and cement China's role as a global manufacturing powerhouse. But as time has passed, the side effects of such policies have become clear, leading to a system where growth is increasingly fueled by credit expansion rather than productivity gains, a dynamic that many economists argue is unsustainable in the long run. The most visible and internationally discussed manifestation of China's debt problem has been the real estate crisis epitomized by the collapse of property giants such as Evergrande and Country Garden, whose downfall exposed the fragility of a housing market long considered the backbone of Chinese household wealth and a key driver of economic growth, since housing not only represented the largest share of household assets, but also underpinned local government revenues through land sales and taxes, meaning that the weakening of this sector has ripple effects across the entire financial system. Local governments, for their part, have accumulated massive debt loads, much of it hidden off balance sheet through local government financing vehicles, LGFVs, entities that borrowed heavily to fund infrastructure projects, roads, bridges, subways, and industrial parks, many of which failed to generate sufficient returns to cover interest payments, leaving municipalities increasingly reliant on new borrowing to roll over old debt, creating a dangerous cycle reminiscent of a Ponzi-like structure that Beijing is now struggling to contain without triggering widespread defaults or social instability. At the same time, household debt, primarily in the form of mortgages, has ballooned over the past decade as families stretched their finances to buy apartments at ever-rising prices, believing property to be a safe and appreciating investment. But with home prices now stagnating or falling in many cities, and with demographic shifts reducing future housing demand, households are becoming more cautious, cutting back on consumption and reducing their appetite for new borrowing, which in turn weakens overall domestic demand and complicates Beijing's efforts to rebalance the economy toward a more consumption-driven model. The corporate sector, too, carries enormous liabilities, particularly state-owned enterprises, SOEs, that have long benefited from preferential access to cheap credit from state banks, allowing them to expand and invest regardless of efficiency or profitability, resulting in a glut of excess capacity in industries such as steel, cement, and coal, and leaving banks saddled with non-performing loans that are often rolled over rather than written off, masking the true extent of financial risk. Adding to these challenges is the fact that China's total debt-to-GDP ratio has soared to levels that rival or even surpass those of advanced economies. But unlike those countries, China is still classified as an emerging market with lower per capita income and weaker institutional safeguards, making the debt burden more precarious and raising questions about the government's ability to manage it without either inflating away the liabilities, engineering a painful restructuring, or allowing defaults to cascade through the system. Beijing has tools at its disposal, including its control over state-owned banks, its ability to enforce capital controls, and its strong centralized authority, all of which give it more leeway to manage crises compared to more market-driven economies. But these same tools also reduce market discipline and transparency, meaning problems can be hidden or postponed rather than solved, creating risks of sudden instability if confidence erodes. International observers worry that China's debt problem is not merely a domestic issue, but one with global implications, since a sharp slowdown or financial crisis in the world's second-largest economy would reverberate through supply chains, commodities, markets, global trade, and financial systems worldwide, potentially triggering a broader downturn, especially in emerging markets, heavily reliant on Chinese demand for exports and investment. Another critical dimension is the political economy of debt in China, where the central government in Beijing often relies on local governments to deliver growth targets, leading local officials to borrow and invest aggressively in order to meet performance metrics tied to their career advancement, creating moral hazard and perverse incentives that perpetuate overborrowing and inefficient allocation of capital. While the absence of fully independent financial institutions or a free press makes it difficult for risks to be identified and addressed early, further compounding the structural weaknesses. Attempts by Beijing to deleverage the economy, such as curbing shadow banking, restricting property speculation, and tightening lending standards, have often resulted in slower growth, which the leadership finds politically unacceptable, prompting them to reverse course and stimulate credit again, thereby undermining reform efforts and reinforcing the cycle of debt dependence. Looking forward, the debt problem is likely to be exacerbated by demographic headwinds. As China faces a rapidly aging population, a shrinking workforce, and declining fertility rates, all of which will reduce potential growth and strain public finances as pension and healthcare costs rise, making it harder to grow out of debt. In addition, geopolitical tensions, particularly with the United States and its allies, are dampening foreign investment, restricting access to advanced technologies, and increasing uncertainty, further weighing on growth prospects and limiting Beijing's room to maneuver economically. Ultimately, China's debt problem represents not just a financial challenge, but a broader test of its economic model, governance system, and ability to transition from an investment-heavy debt-fueled growth model to one that is more balanced, sustainable, and innovation-driven. But such a transition is fraught with difficulty and risk, especially as entrenched interests within the state sector, local governments, and real estate industry resist painful reforms. The world will be watching closely to see whether China can defuse its mounting liabilities gradually through controlled restructuring and continued growth, or whether it will eventually face a debt reckoning that could mark the end of an era of unprecedented expansion and usher in a period of stagnation, instability, and global economic repercussions.